Hey, well, good morning, everyone. Happy to have all of you here. My name is Jeremy Morris. I'm joined again by Mark Gingrich to talk some more PPP and Paycheck Protection Program and specifically some new guidance related to that. Some housekeeping items as we typically do related to these webinars. We have everybody on mute. We do plan on having time to answer questions. We would ask so that this goes a little bit more, it's a little bit less chaotic, that you ask those questions via the question and answer box, and we will answer those either throughout the presentation as warranted, and we will definitely, as we've always done, leave time at the end to answer questions. So again, we're happy to have all of you guys here today. This is the third in a series of webinars that we've done, in addition to other guidance that we've provided throughout this entire process. I will say this at the outset, though, to Mark and I, this probably feels like more like our fourth presentation. To give you a little bit of some backstory, which is kind of indicative of how this entire process has gone. The Paycheck Protection Program Flexibility Act, or the Flexibility Act, in short, that we'll be talking about today, it was passed and signed into law on June 5th. And so we knew at the time there had to be an update to be done with that, but there were a lot of questions still outstanding that were raised by this new guidance. And so, we knew we had to get out there in front of it, but we also wanted to wait, we wanted to wait until we got that guidance before we did anything associated with it. So beginning of last week, we still hadn't received any guidance, and we were coming up on the end of 8 weeks for a lot of taxpayers or a lot of borrowers. And so we thought we can't wait any longer to do this, to get this information out there, because there are some decision points that may need to be dealt with. And, businesses are going to have to make some decisions. So even though we don't have the guidance, let's go ahead and record an update to the presentations we'd previously done. So we did that last Tuesday afternoon. And then in the process, in the subsequent 8 hours after we recorded that presentation, the Treasury and SBA released the guidance and the new applications that we'd been waiting for, thus invalidating the vast majority of that presentation that we had done last week. And so, it's just kind of, it's sort of, again, kind of a funny representation of how this has gone, given the fact that we've kind of been trying to piece all of this together based upon guidance that has trickled out, really since the beginning of April or late March. So again, throughout the whole process, so on a serious note, we will continue. We know there's still some guidance out there. We will continue to work with you guys and keep you on top of everything throughout this process, as we've done from the beginning. But hopefully this presentation has a little bit longer shelf life than that doomed presentation from last week. So with that, we're going to jump right into this. So June 5th, they being Congress, and the president signed the Paycheck Protection Program Flexibility Act to do just that, because there were a number of reasons why a lot of businesses were able to get in and get the PPP funds, but based upon the timing of that, given how quickly the loans had to close and how you couldn't defer the receipt of the loan proceeds, which start at the 8-week clock, on top of the fact that a lot of businesses were still under stay-at-home orders and maybe not operating at full capacity, a lot of businesses were worried about how they would be able to properly maximize the forgiveness associated with this. And that was the last presentation that we gave, was strictly on that, how to maximize forgiveness within that framework. So knowing that that was going to be a problem, Congress, again, passed the Flexibility Act to provide just that, to hopefully make it easier for businesses that have received PPP proceeds to get full forgiveness or more forgiveness than what they otherwise would have before the act was passed. So as we talk through this today, we're going to talk about the steps associated with maximizing forgiveness. We're going to go back through that. This is a 7-step process that we have been talking about from the beginning. So if we look at the next slide, this is the same 7-step process that we've talked about before. Nothing about this has changed. And so, as far as the steps, but the strategies, the overall strategies associated with this have definitely changed as it relates to pre-Flexibility Act and post-Flexibility Act. So we still have the same issues. We have to use the PPP funds on good cost, okay? And we've talked about that. And as we go through this, let me just set out at the outset, we are not going to reiterate all of the rules that we've talked about related to this. We have those previous presentations that talk through this. We're going to talk about those things that changed and focus on an overall planning aspect associated with this. But, if there's something that you have questions about that did not change in the Flexibility Act, shoot us a message, or you can go to the previous slides that we had related to previous webinars, and all of that information will be the same. But bottom line, still have to spend all of the money on what we call good cost. You have to pay for the right expenses with the money. You have to pay people enough. In other words, you can't, there's still, with some exceptions, you can't reduce wages or salaries, during the covered period. You have to pay the right number of people. Again, there are reductions in forgiveness associated with having a reduction in employees or hours worked. If you do have those problems, though, you still have the opportunity to fix them, although that may be less relevant now given some of the things we'll be talking about, which may make it more likely to not have to worry about, for example, that step 3 in those problems. But again, we'll talk about that in a minute. You still have to make sure the payroll cap works. In other words, your payroll costs have to maintain a certain level or have to rise to a certain level of your overall forgiveness. Otherwise, some of your forgiveness will be reduced. And then once you do all of that, you put it together, you calculate your forgiveness, and you do the paperwork. So that's still the framework that we're going to be talking about. And we're going to go through this process using those steps, but we want to only focus on those things that have changed. And after the Flexibility Act, there has been a very significant change in focus, at least as far as Mark and I are concerned. And so with that, I'm going to turn it over to Mark to discuss kind of those big high-level changes before we get into some of the details, to hopefully keep you focused on big picture before we get into the weeds a little bit. So Mark?
Thanks, Jeremy. So the big thing that the Flexibility Act did was, as Jeremy said, it gave businesses by default up to 24 weeks to spend what the old law thought that they should spend in 8. So we're going to describe these periods as we have the old 8-week period, and then we have what amounts to a 16-week extension that bridges this gap between weeks 9 and 24. So what this means is that we have more period to count costs that Congress initially had calculated thinking that our spend would be in a short period of time. So for many businesses, good costs are going to be abundant. And so that's something to keep in mind. We spent a lot of time in our earlier presentations covering what costs are in, what costs are out, what costs are questionable. And we have less pressure on our good costs. And so there are some costs that we might sit down and say, man, they sure look like they qualify, but we're still not sure based on guidance. And we say, well, we don't really care what the answer to the question is, because we have so many costs that are clearly qualified, we can just cast the others aside. And we'll talk a lot about that over the course of the presentation here today. So, I like to think of things as existing in buckets. And so we're going to have a bucket of obvious good costs that were incurred or paid within the 8-week period. We're going to have a group of arguable good costs within that same period. And then we're going to have a bucket of obvious good costs incurred during the 16-week extension period, and some arguable good costs within the 16-week extension period. And businesses are going to have the ability to pick and choose which ones they want to claim if they have more definite good costs, obvious good costs, or obvious good costs plus arguable good costs than they need. We can not lean as heavily on the arguable good costs. So that's something to keep in mind as we work our way through this, is the definitions aren't as critical for many businesses now. Deductibility is something we did not get an answer to. So as the law stands today, costs funded with PPP dollars that would otherwise be deductible are not deductible. The loan proceeds, once forgiven, that's not taxable income. But if a business has used forgiven PPP dollars to fund its costs, as the law stands today, those costs are not deductible, but we're still looking to Congress to fix that problem. I think if you polled Jeremy and me right now, we'd say I'd bet on that fix, but hey, it's Congress. We don't bet on what they may or may not do. All right, this fourth bullet point on this slide is really important. Each business controls which costs they count. That's a point we made a minute ago in talking through the 8 and 16-week extensions. So what that means is we have an opportunity in many businesses to evaluate whether it's valuable to be able to state the following. Our business spent 100% of our PPP dollars on our employees. And if one of the things that the federal government has waffled on is the extent to which PPP borrowers will be made public. And the administration came out a couple of weeks ago and said, none of this will be public, got pushed back and said, okay, any borrower that took out a loan above 150 grand, there's going to be publicly available information about some of their borrowing activity with kind of general high level information. So everyone who took PPP money, more than 150 grand, you're going to be out there in publicly available information as outed as a PPP borrower. And so Jeremy and I both think that if we can help our clients get to a conclusion that they can make that statement, we spent 100% of the PPP money on our employees, that there is potential value in being able to do that. And if we don't need any of our non-payroll good costs, rent, utilities, mortgage interest, if we can now get to full forgiveness based only on our payroll costs incurred during the 24-week window, we see value in that. And for reasons we'll talk about throughout the presentation, that may be the course that many of you on this call want to take. So Jeremy, let me kick it back over to you and walk through step one of our maximization formula, spending the right amount on good costs.
All right, thank you, Mark. Yeah, and there are a handful of questions now, and we'll get to those, I think, in the next few minutes. Either Mark or I will, because I think they're all related to the same thing, is about what period of time do we use. And so let's jump right into this, and I think we can answer those questions as we do it. So the first step was obviously we have to fill the bucket with good cost, and as Mark just pointed out, the decision point is still, none of those good costs have changed, I guess. Let's put it that way. None of those good costs, the definition of what we call good cost is relatively unchanged, but what may have changed now is which good cost we decide we want to choose to apply for forgiveness related to. But generally speaking, if it was a good cost before, it is still a good cost now. Payroll, rent, utilities, interest. That's the same. But what's happened is that we do have a change in the period of time with which we can have the spend on good cost. So under the old rules, generally speaking, we were under a paid or incurred. So any payroll costs that were paid within the 8 weeks, which was the old period of time, starting on the date that the loan was first funded, or that alternative payroll period, again, for biweekly or more frequent payroll businesses, beginning with either one of those start dates, you got all of the payroll that you paid, as well as anything that was incurred but not paid by the end of the 8 weeks, so long as it was paid on the next pay date. With the Flexibility Act, they've created, as Mark said, a 24-week period, but it's the same concept. You get the cost paid during the 24 weeks, even if those costs on the front end that you paid were related to periods of time before the 24 weeks, as well as any of the costs incurred but not paid at the end of the 24 weeks. Okay? Now, having said that, the concept of paid and incurred becomes a lot less important because we have a significantly longer period of time with which to count good cost. But needless to say, they didn't change this. Now, when we talk about these 24-week periods, though, Mark's going to mention, we're going to talk about this in the next slide. We've received guidance as of Wednesday morning of this week that effectively treats the 24-week period as a maximum period of time. So keep that in mind. If you choose to go beyond the 8 weeks, you do not necessarily have to wait for the full 24 weeks to apply for forgiveness. And I'll leave it there for now. but I think that gets at the handful of the almost half dozen questions that we have right now, is you don't necessarily have to wait till the end of the 24 weeks. So we went from 8 weeks to 24 weeks, but they didn't allow you to count all of the payroll in all circumstances. There were limits because they didn't want payroll above a certain level to count. So that magic annualized payroll number is $100,000 per employee. So under the 8-week test, you could receive no more than $15,385 of forgiveness per employee, which that equates to 8 weeks worth of compensation at $100,000 annualized. No matter how much you paid a person during that period of time, during the 8 weeks, $15,385 was your limit. So with the 24 weeks, they have extended that out, which makes sense. So in other words, for general employees, and we're going to leave owner employees off to the side for a second, but non-owner employees, cash compensation is now limited to the 24-week equivalent of $100,000 or $46,154. Now, as I just mentioned, though, you don't necessarily have to wait for the entire 24 weeks to apply for forgiveness. So what I'm about to say is not explicitly stated anywhere in the guidance that we received on Wednesday, but it seems to follow logically. If you choose a period of time, if you count costs through a period of time greater than 8 weeks, but less than 24 weeks, that should cap, that new amount or that new period of time should cap the compensation. So in other words, if I'm counting payroll costs through 10 weeks, and that's all I need to do to get forgiveness, and I want to apply after 10 weeks, the maximum amount of compensation, in our opinion, that you can count for any employee is the 10-week equivalent of $100,000, not the full 24-week equivalent. So you can't jam 24 weeks worth of payroll into a 10-week period and count all 24 weeks. Okay. You're going to be subject to different limitations in between there. That holds true for an owner employee with one slight difference. And this came in with the new guidance that we received after the Flexibility Act was passed. Under the old rule, you got 8 weeks, again, the 8-week equivalent of $15,385, or if less, 8 weeks worth of 2019 compensation for that owner employee. They didn't want you putting additional cost in the bucket by increasing an owner's salary from 2019. So you were limited to the lesser of $15,385 or 8 weeks worth of that owner's 2019 compensation. Where they've changed that is they are not giving owner employees the full 24 weeks. You get the lesser of $20,833 for an owner employee, which is 2.5 months worth of the $100,000 of compensation, or 2.5 months worth of 2019 compensation, whichever is less. Here's a policy rationale behind this. If I was an owner and I had $100,000 worth of compensation in 2019, my loan was based on 2.5 months worth of $100,000 of compensation, or $2,833. Congress does not want that owner to receive forgiveness in an amount greater than the loan they received associated with their comp, because there would be situations where if you had, say, one owner and one employee, without this rule, there might be a situation where you could lay off that employee, use your owner compensation for 24 weeks to cover that shortfall and get full forgiveness, even though you've really not done what they wanted you to do, which was to keep people employed. So it becomes a 2.5 month maximum that you can count for owner employee compensation. If you have a self-employed individual, same concept. You got your loan based upon 2.5 months of 2019 self-employment income. The maximum forgiveness you can get using the 24-week period is 2.5 months worth of that same 2019 compensation if you choose the 24-week period. And again, if you choose that's the absolute maximum you can go. If you choose a period of time between 8 weeks and that 2.5 months, you're going to have a limitation similar to what I mentioned for the cash compensation of regular employees. Okay? So that's payroll. So I think that covers most of the questions. Well, let's go back to that one more second, if you don't mind, back to that previous slide. So I think that covers most of these questions. As it relates to benefits, I don't really want to get in the weeds too deeply here. But generally speaking, if it's retirement benefits paid on behalf of, say, C Corp owners or S Corp owners, those count on top of the payroll costs that we talked about here, on top of these limits, but you're still limited to 2019 levels of retirement contributions on behalf of owner employees in S Corps and C Corps. You do not get to count retirement or health insurance for self-employed individuals on Schedule Cs or general partners that are partners in a partnership. You do not get to count health insurance paid on their behalf or retirement contributions. You get to count health insurance for C Corp owners, and you get to count them for S Corp owners, but they do count towards your $100,000 compensation max. Okay, so there are some nuances here that we could talk about specifically personally in more detail if you have them. But remember, take whatever period of time that you're looking at. At most, you get that equivalent of $100,000, or in the case of owners, that equivalent percentage of their 2019 compensation. As it relates to non-payroll good cost, same concept. We used to get 8 weeks either paid or incurred. Now we get 24 weeks paid or incurred. And if we choose to pay non-payroll good cost, and we choose to apply for forgiveness within a period of time of less than 24 weeks but more than 8, apply the equivalent limitation. So if you apply after 10 weeks, you only get the 10-week equivalent. Well, I guess that doesn't really matter in this case. You only get to count them through the 10 weeks. I think what I would say, though, related to that is I would not be concerned about, I don't know that you necessarily get incurred costs. So count everything through the 10 weeks. If that's where you want to stop payroll, you get paid through the 10 weeks for non-payroll good cost as well. But as Mark and I, as he's alluded to, and we will continue to mention, we think there's some incentive for a lot of businesses to fill the good cost bucket with payroll cost only, and then ignore those non-payroll good cost. So that's a lot of information on that. But Mark's going to talk in a little bit more detail about this whole election between the 8 weeks and 24 weeks.
Yeah, and I know we'll get a lot of questions over this as well. So by default, after the Flexibility Act, 24 weeks is the period of time that everyone's playing by. For borrowers that took out their loans before June 5th, they have the ability to elect an 8-week period instead. So this came out, we said, okay, well, why would somebody want to do that? And here's why a business might. A business that has achieved full forgiveness after the 8-week period will, A, get off this wild roller coaster we're on called PPP loan forgiveness, and won't have to think about it again. So that's a benefit that I know lots of you on this call are pining for. The other benefit is that employer can then adjust the pay rate or the FTE count for his or her business with impunity without having to think about what impact that might have on PPP loan forgiveness. So those are the two reasons why someone might want to choose an 8-week period, but it's going to be hard for most businesses to be able to state, I spent all of the PPP money on payroll costs if they elect an 8-week period. And so I think we need to weigh the benefits of getting off the roller coaster sooner, or having the flexibility to adjust FTE counts or wages prospectively. We need to weigh that against the benefit of being able to say, I spent it all on payroll costs. We thought that this election for an 8-week period might be more compelling because before the Treasury and the SBA came out and said businesses that meet their spend, that spend all their loan on good costs after week 8, but before week 24, can go ahead and apply for forgiveness based on their spend through those dates. So what they essentially said is that businesses have control over when they apply for forgiveness and which costs they count. And so because of that, it seems likely to us that the risk of a second wave or some event that would cause a business to want to reduce pay rates or to want to drastically reduce FTEs later in the 24-week period, that concern goes away, because they can go ahead and file after, say, week 16, get their full forgiveness, and then once they get full forgiveness, if in week 20 something bad happens and they need to cut back on wages or cut back on workforce, then they can go ahead and do so. So there's not as much of a difficult choice between 8 week and 24 weeks as we would have thought last week. Okay, so key takeaways from this slide. We have time. These determinations can be made with hindsight, and no business is going to be forced to apply for forgiveness before next April. So we have time to make these determinations. We have the time to use hindsight. We have time to figure out whether we want to count all payroll good costs or some non-payroll good costs. The only place where we do not have hindsight is if you're coming up on the tail end of your 8-week period and you think you might want to reduce workforce or reduce pay rates going forward, then it might behoove your business to look for opportunities to make sure that you have enough good costs actually paid or incurred and paid promptly thereafter within that 8-week period, so that you could achieve full forgiveness based on that 8-week period if you thought you were going to promptly reduce FTEs or reduce pay rates for some of your employees. But aside from that, we see most businesses, the rule is going to be you have up to 24 weeks. You get to decide which good costs are in and which ones you choose not to count if there are an abundance of good costs. And as soon as you've gotten to 100% of your loan balance using the cost that you choose to count, then you can stop counting and turn in your application if you want to, or you can wait up to 10 months after the end of your period to apply for that. So that takes us to April of next year. So we have time and we have flexibility, and that's what this Flexibility Act was all about. Jeremy, can you walk us through what we mean when we say pay people enough?
Absolutely. And I will go backtrack just 1 second about a follow-up question we received, just to kind of put a bow on this, because I think it's also instructive from an overall policy standpoint and strategy standpoint. So the question was looking for clarification on owner employees. So let me provide the detail, but then one really big caveat as to why I wouldn't lose sleep over this rule. If it is an S Corp owner, you get up to the pro rata share of $100,000 of compensation, or the pro rata share of 2019 compensation, inclusive of health insurance. So you do not get to add health insurance in total on top of that. It goes towards a $100,000 limit if it's an S Corp shareholder. But you do get to claim the retirement contributions on behalf of that S Corp shareholder, but not in an amount more than what it was in 2019. If it is a C Corp owner employee, you get the compensation up to the weekly equivalent of $100,000, right? The annualized, limited with the $100,000 max in annualized comp, plus retirement paid on their behalf, plus health insurance paid on their behalf, but not to exceed the 2019 levels. That's the technically correct answer. Having said that, because of what Mark has talked about, and we will continue to say this throughout this presentation, given the longer period of time, the likelihood of you being able to fill your bucket with good cost, exclusive of even worrying about items like owner compensation, becomes much more likely. So then it becomes almost a policy decision or a PR type of decision to say, do we even want to count owner compensation or owner retirement in our good cost bucket? Because you can probably get enough good cost in 24 weeks in most circumstances based upon non-owner employee compensation. So just keep that in mind. Again, the rules do get a little technical on some of this. And the beauty of this is we may not have to deal with as many of those questions as we did before because of the fact we have the flexibility to choose not just 24 weeks, but some period of time between 24 weeks and 8 weeks. Okay, so that's kind of the policy aspect associated with this. So next step then, we have to pay people enough. All right, and associated with that, this really has not changed as far from this point of view. What they are concerned about is during the covered period, when compared to quarter one, for any given employee who is not a quote unquote highly compensated employee, that means during any period of time in 2019, their annualized income was not greater than 100,000. For any non-highly compensated employee, did you reduce at the individual employee level, and you have to look at this on an employee by employee basis, their hourly rate, their hourly wage, or their annualized salary more than 25%. We're still looking at whether or not it's a more than 25% reduction. The only difference is we're calculating it either in 24 weeks by default, or 8 weeks if we elect to stick with the 8, or something in between if you choose 24 weeks but decide to file early. So you're still doing the same test, but you're looking at it through a different period of time. And again, it seems to us that if you choose a 10-week forgiveness period, then you only have to worry about reductions through week 10. We do not have explicit guidance that says this, but that's the only thing logically that makes sense, because if you had to look at wage reductions through the entire 24-week period, that negates your ability, that negates the benefit of being able to elect to apply for forgiveness after 10 weeks in my example, if you have to wait until 24 weeks to determine whether you've had a reduction in wages. So again, we don't have explicit guidance on this, but that seems to be the only logical conclusion. So again, you're looking at the wage reduction, you're calculating it the same way, but the period of time with which you're viewing that changes, either 24 weeks, 8 weeks, or something in between. And that's basically all that we need to worry about associated with the wage reduction. So that then takes us to step 3, and I'm going to go ahead and already kick it back to Mark.
Here I am. I tried to talk while muted. Sorry. We have this down to one slide. I saw a comment or a question come in saying, hey, can you help us figure out how to count FTE levels? And most of what we've covered in our May 27th presentation on FTE counting still holds. So while I was excited to get this down to one slide, I am going to omit some information that for people who care about counting FTEs may be relevant and helpful. That said, let me tell you why we cut it down. We're going to talk in a second about a loophole, an exception that Congress created in the Flexibility Act that seemed too good to be true. Jeremy and I last week doubted whether it was as good as it seemed. And this week we got an example from SBA and Treasury saying, yes, it is as good as it seems. And so we'll go over that here in a second. So before we do, let's dive in and make sure we're oriented and know what we're talking about. We're talking about a requirement that in order to get full forgiveness, we need to maintain our FTE levels for relative to a base period, and we get to choose a base period either January and February of 2020, or a period February 15th through June 30th of 2019. So for non-seasonal businesses, those are our base periods. People will select the lower of the two because you want a low base period. And then we will compare. We'll compare FTE levels for an 8-week period. We'll compare FTE levels for the 24-week period if we didn't elect the 8-week period. Or as Jeremy and I think the rule has to be, it's going to be on a cutoff basis based on your application if you apply between weeks 8 and 24. And so if you're using costs through week 10, that we would be doing this FTE math through week 10. Okay, so we're going to look at what we did for our covered period, whether it's a 24-week period or an 8-week period or our in-between period because we cut it off early. And we're going to compare that back to our base period. If there's a reduction, then we'll talk about what happens. But if there's no reduction, then you've passed this test. And I'll let Jeremy talk about that exception of what happens if you don't pass the test. But next, before I do, I want to talk about what we are calling the gigantic safe harbor exception. And we'll try to refer to it consistently throughout this because we've had exceptions and exceptions to exceptions and safe harbors and other things throughout this. So we're calling this one the gigantic safe harbor exception. Last week, we thought it was huge. Now we think it's gigantic. Here's the example we got. ABC company sells online and in stores. ABC is a non-essential business. Missouri ordered all non-essential businesses to close for some period during our shutdown in March and April. This example and the guidance from Congress on this point says if that closure, if that reduction in business activity is the test, a reduction in business activity was the result of guidance from OSHA, HHS, CDC, SBA has expanded that to say, or state and local governments relying on general guidance promulgated from those 3 federal organizations. So any reduction in business activity that we can link in any way back to guidance from HHS, CDC, or OSHA, then we do not care about FTEs. Let me say that again. This pay the right number of people requirement vanishes into thin air for non-essential businesses that closed, period. What about essential businesses? For essential businesses, we would need to be able to say there was a reduction in business activity measured in some way. Client service hours, number of units sold, hours were able to be open, something. They don't say what metric we need to use, but we want to hang our hat on there being some reduction in business activity that was the result of our businesses following CDC, OSHA, HHS guidance, or guidance from state and local authorities that was predicated on things that the feds were saying. So there's the potential that even for essential businesses, this is a gigantic safe harbor if you can show a reduction in business activity and link it back to something that the state or federal government was telling you to do. What it does not do is absolve all businesses suffering some form of COVID-related disruption from the FTE count. So if hypothetically we operated a restaurant and we could operate that restaurant at full capacity, but for the fact that no one wanted to come to our restaurant because of COVID, then we would find ourselves failing to meet this requirement. But because that restaurant is going to be able to show that they were actually forced to close and had what we thought this might mean is for after the closure, if HHS or those types of organizations were forcing us to have limited constrained business activity after a closure, that we were absolved from the FTE requirement. But the example from the SBA makes clear that that a reduction in business activity, even if it was during the initial closure, if it was because the business is following what the government told them to do, then we do not have to worry about FTEs. So we describe this as the gigantic safe harbor exception for that reason. For businesses that don't meet the gigantic safe harbor exception, they still are going to have to worry about FTE math. And we still have a rule, it's now codified, and this is the third bullet point on this slide. We have a codified rule now that lets us count as phantom employees, is our word for it. Those individuals that voluntarily left the business or were told to leave, and the business said, we'd like to have you back. and the employee said, no thanks, I'm going to stay on unemployment, or I found another job. If a business was unable to find someone else to fill that person's shoes, then we can count those people back as phantom employees. Pretend like they were in our employment for purposes of the FTE calculation only, even though they weren't. But most of us on this call are going to drive through the gigantic safe harbor exception, and FTE math is going to be something that we reminisce about and don't really have to wrestle with. Jeremy, I'm sure we had some questions flow in on that one. We might pause for a second to address those, but or else we can turn to what happens if we care about FTE math and we need to fix something with our wages or our FTE count.
Yeah, I saw those. Maybe let's save those. Here's what I was thinking related to those. And Mark, you can tell me if you're okay with this. You know, we're getting a lot of questions related to FTEs, and Mark and I will answer those questions. Maybe instead of getting in the weeds of specifics right now, you know, let's stick to the high level, and we will get to those questions. But I think that last conversation that Mark just led us through, I think is important. We will answer these questions related to FTEs as best we can, again, knowing there's still a little bit of unknowns related to this. FTEs, and particularly what we are going to talk about right now in step 4, is still the one area that if you have to utilize this fix, it is still the one area that has, I think, the most unknowns, and it's in most need of guidance. Having said that, though, the guidance, this whole step in general, may be a lot less relevant. So again, we will talk about FTE counts and we will go through those questions. But I think as you are thinking about these things, ask yourself this question before anything else. Can you answer in the affirmative? Can you answer to the affirmative whether or not you meet that requirement, that gigantic safe harbor exception that Mark talked about in the last slide? Can you certify or state or represent that your business suffered a reduction in business activity due to restrictions recommended by those agencies or recommended by state and local governments, which were using recommendations from the CDC and OSHA and Health and Human Services to create those stay-at-home orders? If you were subject to one of those and you can point to some reduction in business activity, whether it's financial or number of customers or ability to even be open, then you can save yourself a lot of worrying and not even mess with the FTE calculation math. Okay? Because if you can answer that question in the affirmative and say, yes, that applies to me, then the FTE becomes an irrelevant measure of anything. You don't have to worry about it because of this safe harbor. If you can't answer that in the affirmative, then all of these questions that we've dealt with in previous presentations and that we'll deal with now that are really good questions, you know, that because, you know, there's a lot of gray area here, those become relevant again. Then it's how do we either put ourselves in a position to not calculate or have an FTE reduction, or if we had an FTE reduction, that takes us to step 4, which we'll talk about now, and how do we make that right? So that was a long way of saying on this first bullet point, those of you that want to pay attention to step 4 are those businesses that reduced wages during the covered period or reduced your FTE counts during that covered period for whatever period of time it is that we're talking about relative to your baseline period. And even though you had an FTE reduction, it doesn't meet that gigantic safe harbor. And the reduction in FTE count was between February 15th and April 26th. If you fall into either of those buckets, then this is for you. If you don't, you guys can go for the next couple of minutes, grab a coffee based upon some of the people I see participating, maybe grab a Budweiser, have yourself a drink, and you can come back to us when we get to step 5, okay? So here's the deal with step 4. Here's where we're at. So if we move along to the next slide, this is a situation where we had a reduction in wages, you know, more than 25%, or we had a reduction in FTEs. and it's either not excused, you know, it wasn't a voluntary reduction in hours by the employee, it wasn't firing for cause, and it didn't meet that gigantic new safe harbor exception. If you have that, they say all is not lost. They've said from the beginning in the original CARES Act, you have the ability to fix it. And under the old rules, the fix had to be done by June 30th, 2020. That date has now been extended through December 31st, 2020. But having said that, everything reads to us as if it is a no later than. So if you get through the end of your let's say you choose the full 24-week covered period, and you have had a reduction in FTEs, and you don't meet any of the exceptions or any of the safe harbors, if after that 24 weeks, at any time you restore your FTE levels to what they were as of February 15th, then you should meet this step number 4, safe harbor fix. They also refer to this as a safe harbor, which is a little confusing. So again, it doesn't appear based upon the wording and the guidance and the instructions that you have to meet this requirement as of December 31st. If you make right the deficiency in wages or the deficiency employees at any time between the end of that covered period and December 31st of 2020, you should be okay. There is one major exception to this, because there's an exception to everything in this. If you choose the 24-week covered period and you decide you want to apply for forgiveness early, which we know they have given businesses the ability to do, they have also stated that if you have an FTE reduction or a wage reduction, you forfeit the ability to make it up if you choose a forgiveness period of less than 24 weeks. Okay, so if you choose a 24-week period but apply early, this fix is not available to you. So maybe, you know, if we think back to the previous slide, so this is relevant for businesses that either reduced wages, because there is no gigantic safe harbor if you reduced wages more than 25%, or businesses that reduced its FTE count when compared to the baseline, and they don't meet the safe harbor, and the reduction in FTEs came after February 15th, but before April 26th, and that business is choosing to apply for forgiveness before the 24-week, and not choosing to apply for forgiveness before the 24-week period. If you meet all of those requirements, then step 4 is for you. And again, this appears to us that it can be any brief restoration. This is the big area that's still open, is how long do you have to keep people employed? So we get our FTE level back up to where it needs to be. Does that need to be for an entire pay period? Does it need to be for 2? Can it just be for a point in time, for a single pay period? And without any further guidance, I think we would say the answer is it appears to be at a point in time. There doesn't appear to be any clawback based upon not maintaining those employees for some set period of time. But that's the one big question that has been out there from the very beginning, since this bill was passed in late March, and we still do not have guidance related to that. So again, step 4, we still have the ability. We have the ability up to fix any problems up through December 31st. But I would say based upon the Flexibility Act and the guidance we received this week, as Mark has talked about, this is going to be a lot less relevant for a lot of businesses, because we think many businesses will be able to fall under that gigantic safe harbor exception. So with that, that takes us through step 4. Did we have any problems? Okay, and if so, did we fix them? Now we have to apply this last bit of math to determine whether or not we have to limit it because we included too many non-payroll good costs. So Mark, kick it back to you for that.
Thanks, Jeremy. We have a few questions that came in. I'm going to hold those for now and try to get through the rest of the material. That will let everyone have enough time to drop off if they don't want to listen to the whole question and answers, and then we can tackle some of those specific cases that came in on the Q&A on the tail end of the presentation. All right, step 5, we're going to consider the payroll cap. The payroll cap has been a source of a lot of confusion. There are a lot of Wall Street Journal and Forbes and other articles out there that say something to the effect of, in order to get forgiveness, businesses had to spend 75% of the loan on payroll costs. And they make it sound like if you didn't, you fail and you get nothing. And they refer to the loan amount as distinguished from the forgiveness amount. So under the old rules, the question was we had to spend 75% on payroll of what? The total loan? No. The amount of forgiveness requested? Yes. So 75% of the amount of forgiveness requested had to be supported by payroll good costs. So it limited our ability to use non-payroll good costs, rent, utilities, mortgage interest, to support full loan forgiveness if those exceeded 25% of our good costs, was another way to look at that. So Congress gave us a new rule. They worded it pretty clumsily. SBA fixed the wording and said, same rule as before, except replace 75 with 60. Okay, so it should be more flexible. More businesses should be able to qualify. But we returned back to what I call the scrubbed forgiveness application, much like presidential candidates like to have their income tax returns look a certain way before they are disclosed. Certain businesses may want their forgiveness applications to be scrubbed a certain way. And again, we go back to if the newspaper knocks on your door and says, I see you took a PPP loan, can you talk to us about how you use that? Do you want to be able to make the statement, every dollar that was forgiven, we used for payroll costs, period? If so, you will pass the payroll cap with flying colors. You can use 60%, 70%, 80%, 90%, or 100% of your loan forgiveness supporting costs can be payroll costs. And so we plant that seed with you throughout the presentation. Maybe 100% is the number to shoot for if good costs are abundant. Jeremy, can you tie it all together for us with the final forgiveness math?
Yeah, and this thankfully has had the least amount of change of anything that we've talked about. So the same math holds as what it was before, with the exception of periods of time and percentages. So forgiveness. So you do all of this. You do all of those steps 1 through 5, and then we say, okay, forgiveness is the lesser of, well, first the loan amount, because you'll never be able to get forgiveness in an amount greater than the loan for obvious reasons. B, total good costs spent during your covered period, which was 8 weeks and now can be up to 24 weeks. So total good costs spent during that period of time, reduced by any deficiencies that are not covered by an exception or a safe harbor, but only if they are not fixed by the end of this calendar year. So that's your second one. You compare the loan amount to total good cost, subject to any non-excused, non-remedied haircuts or deficiencies due to lower wages and lower FTE calculations. And then you compare both of those to your total payroll costs that are included in those total good cost in B, divided by the payroll percentage of 60%. Again, that used to be 75%. So you apply that final math to determine whether or not your non-payroll good costs are too large of a percentage. So you do those 3 calculations: loan amount, adjusted good cost, payroll cost divided by 60%. Whichever one of those is the lowest amount, that is your forgiveness. So again, same calculation as before. All of the hard work comes before this. And so again, it's just which of these is the lowest amount, and that's what we get our forgiveness based on. So that takes us through the actual calculation piece of this, and it takes us to step 7, and I'll turn this over to Mark, and it's getting the paperwork right. And again, the issue with this is we received, in addition to the guidance, we talked about that presentation that we had to scrub. A big portion of that was related to the fact that not only did we get a revised application for forgiveness, but SBA also released this new EZ form. And so I'll turn it back over to Mark to discuss that.
Thanks, Jeremy. So the new apps are out. We don't know when SBA will begin to accept for those wanting to get off this roller coaster ride. We've talked about we have time. We have at least through April of next year to get the paperwork done and buttoned up. So we have time. And there's going to be a process of pulling together some supporting documents for these applications. And a lot of the complexity of the old form, which is now junk, throw it in the trash if you started scratching it out. It's mostly junk and will probably be a time waster if you try to preserve it. If we take that form and throw it aside, businesses are going to choose between an EZ form that many members of Congress were pushing the SBA to come out with, and the full form. And the big difference between the full form and the EZ form is the FTE math. The EZ form bypasses the FTE math. And so for all those businesses on this call that fit within the gigantic safe harbor exception we discussed, the EZ form is likely for you. Okay? So let's go to the next slide and we'll talk through what that form looks like. So and who can get access to it. So the two main benefits are no FTE math, and FTE calculations are potentially relevant, but you're not going to have, I'm sorry, there is no FTE math. You're still going to need to maintain certain payroll records. You're still going to need to maintain documentation showing that you meet the safe harbor, but you're not going to need to provide the SBA or your lender as much detail on how the FTE considerations work and were calculated. So there's still going to be some payroll information we need to share with them, showing total good costs, the periods of time that were counted, so forth. But we're not going to need to actually do the math. And we have lots of questions sitting in the queue on how to do the math of figuring out what were our equivalents in our baseline measurement period, either February 15th through June 30th of last year, or January and February of 2020 for most businesses. We're not going to need to calculate that relationship of what is our FTEs using a 40-hour work week in the base period, compare it to the cover period. And so that's a compelling benefit that drastically simplifies the form, especially for businesses that have an abundance of good costs and are picking and choosing. And if they're so fortunate, have the ability to pick and choose what Jeremy and I have suggested, which is let's maybe try to get to 100% payroll cost forgiveness if the numbers support it, so that we can only attach payroll detail, not mess with leases, not mess with rents, not mess with mortgage interest statements, and just give them the payroll data and be able to talk to the newspaper reporters and say, we spent it all on our people. Okay, so you get access to the simplified form if you did not have any employees to count. You are a self-employed individual, an independent contractor, sole proprietor. You had no employees. So picture like an ER doc that gets 1099 income as an independent contractor, has no employees. That person, they're in the EZ form. Other people that get into the EZ form beyond that need to be able to demonstrate that they did not reduce wages, as Jeremy described. So if you can say there was no greater than 25% wage reduction for our key group of employees, those that don't fit it within the highly compensated bucket from last year. And either under number 2, you would show that you had no FTE reductions. So you've done the math on a back sheet of paper and you say, yep, we're good. We have enough employees to have the same number in our covered period as we had in our baseline period. Then you can get access to the EZ form. You don't have to show your work. The big, gigantic safe harbor exception is number 3. So if you can put your hand on the Bible and say, I did not reduce my workforce's wages for those important people that made less than $100,000 last year, and I meet the gigantic safe harbor, you get access to the easy form. And so what that means is you're going to show your good cost that you spent. You're going to check and make sure you spent at least 60% on payroll, and you're going to calculate your loan forgiveness and be done. There's going to be some paperwork you have to send in to substantiate those good costs. But for the most part, your application will be a lot easier than it will if you get caught up in the FTE math. So that's where things stand from a paperwork perspective. Jeremy, let's close it out and then we'll go to questions.
Yeah, thank you, Mark. So we've talked about a lot of information. We have had a lot of technical discussions over these last 3 presentations. But again, what Mark and I hope we're able to focus on related to this are big picture items, because our way of thinking based upon the Flexibility Act, 2 rounds of guidance that we've received since then, as recently as Wednesday of this week, plus the new applications, we think changes our way of thinking associated with this without question. So before, we would leave you with this, the old way of thinking related to this, and you can think about, if you were in on those previous webinars, the tone and type of questions we received. The old thinking was, how can we get enough good cost? Can I include this cost into my good cost bucket and get forgiveness associated with it? How much employee compensation or owner compensation can I include? How much of their retirement can I include? Is it okay if my rent is paid to a related party? What about retirement contributions? What about retirement contributions related to 2019? Those are the questions. We were trying to accumulate as many costs as possible and figure out whether or not we could, in good faith, count those as good cost. Because we had a limited period of time to do it. We had a loan that was based upon 2.5 months. We had 8 weeks, of payroll to work with as opposed to 2.5 months. And in a lot of situations, businesses were unable to open fully. So we were looking for every possible expense that we could find to include in the good cost bucket. Well, now with 24 weeks, or some period of time in between 8 weeks and 24 weeks, we have a significantly longer period of time, because our loan was based upon 2.5 months, which I think gets us somewhere around 20% of annual payroll. If we're looking at how much payroll we have over a 24-week period, if we're fully staffed, that's, over 40%. That's coming up on 50% of our payroll for the year falls within that period. Even if you've had a reduction in business, that 24 weeks should give you, and hopefully give most businesses enough time to ramp up their businesses, get their employees back, pay them, and fill the good cost bucket. So the question isn't how do we fill the bucket with good cost, but it's what good cost do we want to include in the bucket? Again, it's that hypothetical conversation that you're going to be having with your local newspaper reporter, your local television personality. It says, hey, I see your business received a PPP loan. Explain to us how you use those proceeds. You have the ability now, most businesses, I should say, have the ability to dictate how they want to answer that question. So it's not how do we get enough good cost, but it's how do we, or which of those costs do we want to include? How do we want to communicate it? Okay, how do we want to apply for forgiveness? Under the old rules, and we're still seeing this. Again, we'll go through all of these questions, but we're still getting a lot of questions on how do we make sure the FTE math works? How do I count FTEs? When have I had a reduction? How can I fix that reduction? How long of a period of time does that reduction have to apply for? How does that impact the date that I can apply? All of those are still important questions, but for a large percentage of the businesses that receive PPP loans, suddenly the question isn't how do we make the math work, but it's does the FTE math even apply to us anymore? Because of that gigantic safe harbor exception that we've talked about. The fact that if your business was adversely impacted, you had to reduce business activity, because of guidance released by CDC, Health and Human Services, or OSHA, or you were under a state or local order that was guided by CDC, HHS, or OSHA guidance, then suddenly the FTE math becomes completely irrelevant to you. And so all of these questions about what baseline do I choose? Do I need to make this up? What about people that quit? All of those questions can go to the wayside, and we can put it on the back burner, maybe to use a different cliche, and not even worry about it. And then finally, the question becomes, okay, not how quickly after 8 weeks can we apply, but just when do we choose to apply in general? And by that, that also implies, when do we want to shut off the valve for counting cost? Is it 24 weeks? Is it 8 weeks? Is it something in between? Because we have the ability to affect that. And I know we're going to have a question that deals with this later, and it's a great question. Again, there may be some uncertainty related to it, but seemingly the ability to determine when you shut off the valve, so to speak, for when you count good cost, may also dictate your period of time for counting FTEs and wage reductions. And so you have that strategic thing to keep in mind. So those are the questions that we're at now. And so again, we keep harping on this a little bit because the details are still complicated. But if we can avoid even dealing with the details, then all of us will be in a much better place. If we can not have to worry about the FTE math, then I think all of us will be a heck of a lot happier about it. And it appears to us the Treasury and SBA have given a lot of businesses the ability to, as Mark says, put your hand on the Bible and say, you know what, we meet this requirement. We don't even have to worry about what our FTE level was. So that's our presentation today, the formal presentation. We've put the information here. I know someone has asked for this. All of our previous resources going back to the middle of March, every alert that we've issued, every presentation that we've given, the slides and the recordings are on this website that you see here. The only thing that's not on that website is that ill-fated presentation that was recorded and unused as of last week, the one that became irrelevant within 8 hours of recording. But other than that, everything is on this website. Again, this presentation, the slides, the recordings, all of the Q&A that we'll do here shortly, all of that will be on the website as well. So Mark, anything you want to add before we start jumping into questions?
No, I think that's a great wrap, Jeremy, and let's dive in. Thanks to everyone who tuned in, and we will post this with the Q&A. We have an amazingly endurant attendee list, at least historically we have, who sometimes suffered through hours of Q&A with us. I don't think this one will run that long, but we'll work our way through some of the specific questions that you all have, and that information will later be available for anyone who needs to hop off the call, but wants to hear that. That will also be part of our recording.
Okay, so looking at questions, the first one, I think we did get to that. We can probably clear it. The owner employees, again, if that is relevant to you, you're not only subject to the wage caps, the 8-week or 24-week or wage caps in between, but you also have to look at 2019 compensation for that owner employee and make sure you don't go over the 8-week or 24-week or some period in between percentage of their 2019 compensation as well. Again, you can't increase owner compensation from 19 and 20 and get it to count. So I think we can clear that one out.
Yep, I agree, Jeremy. You did a nice job of highlighting some of the distinctions in the ancillary compensation for those people, depending on the form of business or organization.
So on the FTE count, so we've got a rehire question. Rehired employees mid-pay period, mid-covered period. So within your period of time, you reopen the business, you rehired those employees. Technically, the way the FTE calculation works is it's going to be average FTEs over the entire duration of that covered period, 8 weeks, 24 weeks, or something in between. So the fact that those individuals were not working for some period of time during the covered period will reduce your FTE math. But if that gets you up to the pre-February 15th FTE levels, then seemingly at the end of the 8 weeks or the end of the 24 weeks, if you had an FTE reduction, which you would based upon not having full employment for a period of time within that, if though by the end of that period, at the end of the 24 weeks, you're back up to your regular FTE level as of February 15th, is it what it was on February 15th, then you should meet that old safe harbor requirement of step 4, fixing the deficiency. Now, if you apply for forgiveness early, you don't have the ability to fix that deficiency. And having said all of that, though, and we'll try not to repeat this with every one of these answers, but if you fall under that gigantic safe harbor, then suddenly we don't have to care about this answer, about this question. And again, we won't reiterate that with all of these, but please keep that in mind.
All right, Jeremy, next question was form or worksheet to guide us. And that's been something that I know we and a lot of people have worked to try to provide. And one of the difficulties in it is every time you program the dang thing to work, the rules change. And so I think the short answer is a team that are working on getting that based on the most recent guidance in a format to share. And it is our general preference that we want that to be available because there are efficiencies if all of our client base is kind of working from the same toolkit, and we're able to help them through with a familiar toolkit as opposed to having everyone use a self-created or varying toolkit. So the short answer is yes, stay tuned. And I think we now have enough guidance as of Wednesday of this week to get something close that feels unlikely to be materially changed. But every time you say that, the SBA or Congress does something to make what you just had obsolete.
Yeah. FTE calculation. So this one was in previous presentations, but in a nutshell, take average, say weekly hours per employee, and for every week within the covered period, and then you find the average of the average, but average number of hours per employee per week. If the answer is 40 and above, then that counts as 1 FTE. Anything less than 40 hours per week is a percentage or a fraction to a tenth. So, so 0.7, 0.8, 0.6, or there is a safe harbor you could choose where your answer is either 1 if they're 40 hours and above, or 0.5 if they are anything below 40 hours. Okay. And so you can use either one of those systems, and it just has to be consistent between baseline and covered period, but that's what you're looking at. Next.
Exactly right. Yeah.
I'll go ahead and jump
Jeremy.
into this one.
Okay.
What is the period of time for calculating FTEs? Yeah, okay, so these next 2 questions I think are getting at the same thing. I'll take a first stab, but curious as to Mark's opinion on this. I stand by what I said in the presentation, in that the logical answer is if you choose a period of time after 8 weeks but before 12, that should shut off the calculation of FTEs and the calculation of wages for purposes of this. Otherwise, it takes any of the benefit out of an early application, because you can't apply for something where you don't know the answer to some of the math. You know what I mean? If you have to wait till the end of the 24 weeks. Now, Lynette's point is entirely well taken, in that I'm doing this based upon what I feel it has to be, because otherwise then it completely invalidates an early election. But having said that, there is nothing that explicitly states that we can do this. There's nothing that explicitly states that we can't, but definitely we do not have an explicit blessing associated with this. This is my opinion, and goodness knows I've been wrong whenever I've made assumptions throughout this process on other things that I thought was entirely apparent and logical to me. So, we will keep this audio, and whenever I'm proven wrong related to it, we'll play it in a loop to kind of keep me, honest and humble. But that seems like that should be the answer, is it should cut off at the period of time with which you stop counting costs, but we don't have an official blessing associated with that.
Jeremy, just to restate it a different way, I think, so the question goes to, if you have not spent all your money within 8 weeks, you spend it all by week 10. SBA has said affirmatively, a borrower may submit a loan forgiveness application anytime on or before the maturity date of the loan, including before the end of the covered period, if the borrower has used all of the proceeds for which he or she is requesting forgiveness. So that's an official SBA position, is you can apply early. And so everything Jeremy said is about mechanics, which are the application they've given us asks a borrower to certify whether they've paid the right level of wages and the right number of people today as of application for forgiveness. And there is no provision, there's nothing in the application that says, I will alert the SBA if this changes between my date of application and 24 weeks. And if it did require such an update, it totally obliterates the need or the benefits of applying early. No borrower should apply at week 10. They should just wait until week 24, and that way they don't have to worry about subsequent monitoring and updating it. They just wait till the end of the 24 weeks. So I think that's a little bit more on the reason why Jeremy and I feel so strongly that even though some of this guidance that came out in the last few days, I don't think has totally worked its way through the lending system, that's where we are predicting it to land, because SBA has been very thoughtful, it seems, in their approach, that they want people to be able to apply before week 24. And it seems nonsensical to say, yeah, you can, but it's really not going to matter, because you still got to measure whether you slash people's wages during the full 24-week period. So take that for what it's worth. I think it's a guess, but we think it's a pretty good guess.
Next question is about partnerships. So partnership pays owners guaranteed payments in 2019. So again, think of guaranteed payments as the equivalent of a wage in partnership terms. So partnership pays owners a guaranteed payment in 19. Let me go back.
Sorry, I made it disappear for you.
Question got moved on me. Let's find it.
I'll repeat it here. Partnership paid guaranteed payments, has book income in 19. So it was profitable in 19, but it had a tax loss in 2019. So what the IRS saw was we lost money. And so the question is the PPP forgivable portion related to the partner comp limited by $100,000, the guaranteed payment, or is it limited to nothing? So we have two components, Jeremy, here of partner compensation. We have a net loss from the partnership, which our pro rata share got us no benefit, and we had a guaranteed payment, which was our equivalent of a wage replacement for the partner. So there's the facts. Sorry to move it on you.
No, that's absolutely fine. So as it relates to the pro rata share of profits, since that general partner recognized a tax loss attributed to them for their 2019 partnership income, they should have received no loan proceeds associated with that, because that amount is zero. And likewise, there will be no loan forgiveness associated with the pro rata share of the pass-through profits of the company, because of the partnership, because there was no profit. So if we compartmentalize this, tax loss, so therefore you could take out no loan against that because there wasn't income, and you get no forgiveness associated with it. Now that takes us to the guaranteed payment, the equivalent of a wage, as I mentioned it before. Your loan amount should have been based upon 2.5 months worth of that annual guaranteed payment, again, equivalent to a wage. That amount also sets your limitation for 2020. Again, you can get it, think of it as owner compensation in that slide. You can get the pro rata portion of your 2020 guaranteed payment up until either the 8-week or 24-week or whatever period of time equivalent of 100,000, or that equivalent period of time, that proportional percentage of your 2019 guaranteed payment. So in other words, it'll be based upon 2020 guaranteed payments unless 2020 guaranteed payments are over the lesser of 2019 guaranteed payments or 100,000. The lesser of that 2019 guaranteed payment or $100,000 sets your limit. And then you just apply the percentage based upon the period of time. So it really will be capped based upon 2019, but only for the guaranteed payment portion. Again, we ignore the flow through profit portion because there was no profit in 2019.
Thanks, Jeremy. Next question was, is forgiveness likely to be rejected if all of the loan went to payroll for the employer, for an owner employee during the 8 weeks? And so there are special rules for owner employees that were intended to prevent abuse, but there's absolutely nothing wrong with counting owner employee compensation as a good cost. In fact, it is a good cost. It's a payroll good cost. And so the only reason why I would advocate someone not counting an owner employee payroll in their application is if through employees other than the owner, they could get to full forgiveness, then they might like to be able to go to the newspaper and say, I spent this all on my employees. It wasn't, I didn't take any forgiveness based on payments to me. And aside from it, in a world where there are no non-owner employees, you're absolutely fine. We just got to pay attention to those limits.
Yeah. And, the thing with this is, we again, whether or not you're moved by that idea of, what you would say to the hypothetical newspaper reporter, I mean, that's, a business by business decision, but we do know that a lot of people are very sensitive to that because this process, for lack of a better term, it went from everyone has to get into this and get the money. This is what, we want everyone to take advantage of this, to keep their businesses afloat and to pay people. It became a political process. Anytime you talk about federal money, that tends to be where things go. And so there has become an increased sensitivity related to this about what you are doing with those funds, and I think for some businesses, it is a consideration, especially given the fact that, we know that they will be providing general details about the businesses that participated in this, even those that participated in, in my opinion, at relatively, modest levels of loans. So that's why we keep going back to that. So next question, employee paid COVID sick or family leave. Yeah, let's say you paid that. You paid your employees under the Families First Act, which seems like that was 20 years ago when that was passed. You paid them sick leave or family leave under that act, or those who took unemployment due to medical reasons. How does that affect the FTE counts? I think you get a different answer between the two of those. I don't see any reason why you don't get to count people that you maintained on your payroll who are taking advantage of the COVID sick leave or the COVID family leave. I think the guidance is probably if you were paying them as if they were working full time, they count as a FTE as a full time equivalent, as a full time equivalent, not part time. I think if you were paying them for partial time, I may be misstating this. I don't recall if they go back to look at their historical levels or they look at the level at which you are paying them under this provision. So it may be if they're generally a full-time, you get to count them as full-time. It may be that if you're paying them at full-time, you get to count them at full-time. If you're paying them at anything less than that, that may limit it. But needless to say, they do get a count in your FTE count. Those that were on unemployment, however, I don't think those will count towards your FTE count until you bring them back on. So, the hours that they worked for you during the covered period count towards your FTE count, but I don't think they count for the period of time that they're on unemployment, regardless of the reason that they are on unemployment. Well,
yeah, Jeremy, I guess the only caveat on that one is that the question says if they took unemployment due to medical reasons. And so if you can say that it was a voluntary departure, you gave them a rehire offer and they declined it, then or they decline to come back, then you get to count them as good forever. If it's a voluntary and you can document that it was a voluntary exit, and you were unable to replace that person, then you basically, that's our phantom employee example. You get to count them as your employee for the FTE math. Of course, you won't have their payroll costs in your good costs, but hopefully payroll costs are abundant for you. And so you'll have the potential that it doesn't hurt you at all in the FTE math. Again, all assuming that you can't drive through the gigantic safe harbor.
Yeah, great clarification, Mark. Thank you for that. So yeah, there may be a situation in that set of circumstances where you get to count that person. The other thing to keep in mind, you mentioned that unemployment, doesn't count. You don't get their wages. Same thing, if you were paying them COVID, if you were paying their leave under the Families First Act and it was reimbursed, via payroll tax credits, then you don't get to count those payroll cost as good cost either. So no, but thank you, Mark. Great clarification on that.
The next couple, Jeremy, are on seasonal businesses. And I think it's really getting at a couple of nuances here. One is, if you have a seasonal business, we refer to the general rule for FTE counting and not the specific rule for seasonal businesses. And then the other is if you have what might be viewed as a non-seasonal business, but with a seasonal workforce component. So a CPA firm is something that Jeremy and I are very familiar with. And so, you have the example of if you have 8 interns during busy season, during our traditional tax filing season, and 2 interns the rest of the year, then on an FTE basis, every year that there's going to be this shifting depending on which time period we're talking about. And how do those enter into the math? Again, our hope and the big takeaway from the presentation is, before you try to answer these questions, make sure that the answers matter to your business. But if they matter, the seasonal business definition and that special rule, Jeremy, my view of that is that's on a business by business determination, and there are some businesses that wouldn't be viewed properly as a seasonal business, but have that seasonal workforce element. And I've thought of that as that's just part of your FTE math that potentially cuts against you in the FTE math. Thoughts on that?
No, I would agree with that. I mean, I think that's it. Is that whether or not you're a seasonal business, and again, to my knowledge, that still has not been defined. It's the administrator, correct? I think has the authority to determine who is a seasonal business, and I don't think any rules have been put forth that actually define that.
But what the measurement period is, but not who.
Exactly, and that's exactly where. Yeah, that's exactly right, and that's where I was going. That dictates which baseline period you get to choose. You get 2 defaults for all businesses, and then you get a kind of a broad choice if you're a seasonal business. It dictates the period of time that you can use within your baseline. But once you set your baseline, I don't see any way you can exclude seasonal workers. Then it becomes are they full-time, or are they part-time? Does it make sense to, if they're not over 40 hours a week seasonal employees, then you start playing around with the math to say, do we want to use anyone that's not a 40-hour person as a 0.5, or do we want to do the actual math? And you start playing around with those elections to determine which one gets you the best answer. But yes, it dictates what period you get to use for your baseline. But once you choose that, seasonal employees are employees like everybody else, and so you have to count them for part of the FTE math. And so I think that hit on those 2 questions there.
It did. The next one, Jeremy, is another FTE question, and it's a hypothetical that I've played with a lot in our discussions here at WK, and it deals with what happens if you had an FTE reduction in the first 2 months of 2020. So the first thing that you're going to do is you get to set your baseline period. So you're going to take the lower of your FTEs in January and February of 2020, or your FTEs from February 15, 2019 through June 30th, 2019. So let's assume that the 2019 numbers were higher. So we would like to choose our January and February, but our January and February were inflated by a job that finished during that time frame, and so we've maintained FTEs at a constant level during the COVID period, but it's down from our baseline period because we had some of these special job employees that were still in our count in January. And a really technical reading of the rule would be that we're comparing our covered period FTE count to our baseline, which we've said the baseline was elevated by this hypothetical job that we had a team of people finishing. And so we're short employees. So first question is, can we get out of the FTE math? Let's assume the answer is no. And so we have to do it, and we come up with an answer that during our covered period, let's say we're at 90%. A problem with this fact pattern is we did not have any post-February 15 reduction in FTEs. And the statute seems to make that a prerequisite to have the opportunity to cure by getting back to that January and February level at it's really the February 15th level at some point before December 31st. So in other words, the step 4 that Jeremy went through, where our opportunity to cure is based on at some point before December 31st, we get back to our February 15th level of employment. Technically, that safe harbor, that cure is only available for a business that suffered a reduction in FTEs in a very narrow window of time between February 15th and April 26th of 2020. Now, I think if you pointed out to a senator or a congressperson that they wrote it this way, their jaw would hit the floor, but that's what it says right now. And so it could be that those businesses are shut out of the ability to get back to their February 15th level and count themselves as passing the FTE math at 100%. Again, a point that we've made in other presentations, and Stan's emphasis here, is for a business that doesn't think it fits within the gigantic safe harbor, that is short on FTEs, it's a proportionate reduction in forgiveness. And so if a business is operating at 98% capacity on a $100,000 loan, we're talking about $2,000 in PPP costs. So it's not an all or nothing cliff we're driving off of if we can't get access to the step number 4 opportunity to cure. But again, I know you pointed that out in the presentation, that there is that technical glitch on the timing of reductions, and I think this question hit on that fact pattern.
Yeah, absolutely agree on that. Next question is related to, this gets at that safe harbor, and it's a great question, and one that the person who asked the question probably knows I've been thinking about. So the question is if our customers can't have annual meetings, which required our services due to CDC guidelines, does that meet the gigantic safe harbor exception? One, I like the fact that we now have other people referring to it as a gigantic safe harbor exception. If we've done nothing else in this presentation, we'll have done well because of that. No, so it's a serious question though, and this one I've wrestled with. My opinion is, and Mark hit on it during the presentation, is that I think there is a bit of a distinction here and a nuance. Maybe that's what the word I'm looking for related to this question. If you and your business had to you took steps to reduce activity in response to CDC, Health and Human Services, or state and local guidelines, that counts. If you would have maintained activity as you otherwise would have, but customers chose not to put in orders or utilize your services because they were wanting to abide by those guidelines, I do not think the gigantic safe harbor exception applies. So I think the reading in the way you have stated this question, I don't feel comfortable that we can get to a point where we say that specific set of circumstances would cause a reduction in business activity. Now, having said that, take a look at your business and think about how you operate and say, because of the CDC guidelines, one, were we an essential business? And if we were, and we were allowed to stay open, did we in any way have to adjust? Would we not have been able to utilize as many employees and thus not produce as much during the period of time? Because there was no way that under our old system, normal business activity, there was no way we could conduct normal business activity in a way that would abide by recommendations from CDC, Health and Human Services, or OSHA, as it relates to employee safety, social distancing requirements and the like. If you can point to anything that shows you had to change how you conducted business, forgetting about the client side, the customer side of it, which I know it's difficult because they're intertwined, but would you, in a hypothetical situation where you had all of those meetings and all of those jobs, would you still have had to change how you did business because you wanted to or had to abide by these recommendations? If you can answer that question in the affirmative, I think you're good from a safe harbor standpoint, but there is a bit of a nuance associated with that. And I think what my answer kind of gets at the next question then as well, I'm going to answer this one and throw it to Mark because I'm really curious as to a second opinion on this. The next question is, what if we were not formally required to close, but the state strongly recommended that we do, as did CDC and every other similar organization closed? Okay. And my opinion on this, and again, this is my opinion on this, is that there's nothing that says you are required to. It just says, did you change your business activity based upon recommendations issued by and best practices issued by? I think if you're ordered to stay home, that's the most black and white situation, but I'm not entirely certain that it requires a formal stay-at-home order. I think if you abided by that guidance and local government said, we think you should, but we're not going to require you to do that based upon CDC guidance, I think you're okay. But it's not quite as black and white as a forced shutdown. And with that, I've spoken enough on the topic. Mark, what do you think?
I agree with that, Jeremy. I'd say, let me walk through an example that's real for us. So accounting firms were designated an essential business. So during COVID, many of you got our alerts. We said, our lobby's no longer open to customers. If you need to drop something off, here's how you make arrangements. We said, our auditors are not going to go to client locations. We set policies as a firm in response to guidelines from state, local, and federal organizations. And I think that's the distinction that we're looking for here. Did your organization set policies that reduced your business activity in response to things that the federal, state, and local governments were telling us to do? And if you can answer that question in the affirmative, then you fit within the gigantic safe harbor exception. If you say, our business had a policy that we will send whatever auditors we have to your client location, you guys can come into our lobby and we'll be happy to meet with you, and all our conference rooms are open, business as usual. And no one came because everyone was hunkered down from COVID. That's the situation where we think that there's a problem where you might not fit the safe harbor. You had a reduction in business activity, but it wasn't because you were following what was recommended. It's because other people were following what was recommended. And so I think that's the critical distinction. If you can point to emails and policies and things that your business did that were required of you or recommended to you for public safety and public health purposes by those organizations, directly or indirectly, then that's why this thing's gigantic. If you can answer that yes, then you're within it.
I agree. But Mark, I'm a little disappointed that you used our personal example versus the Great Lake of the Ozarks example that you used in our discussions yesterday. I'll just leave it at that. So, okay, I think we got those. FTE definition, we talked about that previously. Again, average number of hours per week. If it's 40 or above, it's a 1. If it's less than that, it's a pro rata portion to the nearest tenth, or you can choose to just treat anyone not 40 hours to be 0.5. Okay.
Next question, Jeremy, was we now have 24 weeks, so we're going to spend a lot of money. So we spent twice as much as we had loaned, but we had a reduction in FTEs. How do we think about this? So first question is, are we exempted from an FTE requirement? Do we fit within the gigantic safe harbor? If not, is any of our reduction from a decrease in employees that we can call phantom employees? If not, did we cure it? Did our reduction fall within that magic February 15th to April 26th window? And did we fix it at some point between the end of our 24-week period and December 31st of 2020? And if we get through all of those possible outs and we still have an FTE problem, then your math is right. You're going to, if you look back at step number 6, when you look at the slides, putting it all together, the FTE reduction is calculated not based on total good cost spend. It's calculated based on, it's capped at the loan amount. So we can't make up for an FTE shortfall by spending more on good costs. Jeremy, did I say that right?
Yes, I believe you said that correctly. Yeah, you're good. One is, does it matter from an FTE perspective? And 2, it's total good costs subject to the haircut, and you compare that to your total loan. So there are situations, we've had a question beforehand that gets at this that we probably need to directly respond to, that kind of gets at this, what I would call strange math, and that there are situations where, based upon the 24-week period, you could have a reduction in FTEs and still come close to meeting the requirement. Now, I had some questions related to that because the math seems like it shouldn't work. The reduction in FTEs probably caused a reduction in payroll. So it's interesting if you can get to that. But I think obviously with the 24-week period versus 8, or versus the 2.5 months, for example, that you used for the loan amount, it is possible to have that happen.
Thanks. I'm not sure I nailed that question. So I think with Jeremy's clarification, we have it right, that it is in step. If you look at slide 6, the test is you have an embedded total good cost spend subject to these limitations.
Yes.
And if the limitations apply to you, then you have the potential that you, in fact, can make up FTE reductions by increasing your spend.
Yes. Put another way, and this maybe segues into this next question, which I can take. It's, you've got, think back to that slide, it's loan total cost adjusted for these items. So if you have an FTE haircut, you apply that to total good cost within whatever period of time you're using. You do not apply that haircut to the lesser of that or the loan. You apply the haircut to the total good cost and then figure out if that's greater than or less than your loan amount. So you apply it to the second item, you don't apply it to your loan. I think, and I think that's the way to think about it. So the next question, and I was looking at this whenever Mark was answering that previous question, trying to find an answer. And so let me scroll back. I think we might have clicked off of it too quickly. So it says on the easy application.
Oh, sorry.
Page 1's line 5, 6, 7, and 8 appear to have an error. And I'm going to say at the outset, I'm not sure that it does. So let's walk through it. Line 5 is a total of good cost. So I'm looking at a copy of the application. Line 5 on the easy app is total payroll cost for the covered period, mortgage interest, rent, utilities. Total good cost. And so the order is a little bit different than what I showed them on the slide we talked about earlier, but that is one of the line items. So we've got total good cost. And again, there's no adjustments for haircuts because we're talking about the easy form. And the only way you get to use the easy form is if you don't have any haircuts. You don't have any reduction in wages or FTEs that aren't somehow excused. So it's total good cost is line 5. Line 6 is the PPP loan amount, which they state here. Line 6 is the loan amount, and line 7 states that you're to determine the 60% floor for payroll costs. So you divide not total good cost, but payroll cost only divided by 0.6. And so I agree with that. So then you say, okay, total good cost, PPP loan amount, and payroll cost divided by 0.6, whichever one of those is less. And so that's what line 8 says, whichever the smallest figure is, that's the one you should use. So I don't think there's any, I might have misspoke during the presentation and gave, if I apologize if I gave some answer that was other than that, but I think that does hit at the exact final math, so to speak, related to the application. So I think we're okay.
I think you're right there. This next question from Daryl is interesting, Jeremy. So it says, can employees that joined your firm as a result of an asset acquisition occurring during the covered period, do they get to count in your FTE math? And there's in the FTE math, it's full-time equivalents. People are fungible and you're just doing the math.
Yep.
So it doesn't matter whether that person was employed during your baseline period or not. It only matters whether they count as a whole person or a half person or a fractional person. And so the short answer is yes. In a merger situation, if you had two firms that each took PPP money and they merged together, all bets are off there. I don't know.
Yeah, right. I think that is a complicated question. As I like to say whenever I taught, it is beyond the scope of what we were discussing in class today. And we moved on to something that I knew the answer to, but I think that's right. I don't see any reason why. It doesn't matter whether you put an ad in the paper and added to your employee base, or you acquired a business and added to your employee base. Short of the merger issue, where both that Mark just pointed out, I don't think it matters. So next question, the loan forgiveness application asks the questions: employees at time of loan application and employees at time of forgiveness. Is this an FTE calculation, active roster, or number of full-time employees? I think, Mark, that's the right response to this. And it's a great question, but the answer to that is, I think it is not, I would say it is not an FTE calculation. I would say that right off the bat. I think it's an active roster. I think it's a head count. How many people did you have at the time of the application for the loan? That was to determine whether or not you met the 500 employee requirement. To be completely honest with you, I'm not entirely certain I know what the rationale is for including that, other than just including demographic information about the business, because the FTE calculations for both baseline and covered period are very specific calculations, and that's not what's being asked. So I think the purpose of these questions, that was a question that was asked, is I don't exactly know what they were thinking when they put them on there, other than they had space on the application and needed to fill it with something, and that seemed like as good a thing as any. No, I think seriously, it's probably a demographic issue to determine kind of the business size, and maybe as a check on individuals, if you put a head count number in that line and it is drastically different, let's say it's half the amount that you include as your FTE calc, maybe that's a way to kind of throw up a red flag. I don't know, complete conjecture on my part related to that, but it's definitely not it's separate from the FTE calculation.
Quite right. All right. Next question from Mary says, if forgiveness applications aren't filed till 2021, what do we do with this problem where, as the law stands today, some of our costs funded with forgivable money are not deductible? And we really have this issue to the extent that we could, for a lot of businesses that were paying their 2019 retirement contributions, for example, still in 2020, some of those costs could have squeaked into your covered period, and you have this situation as we speak today, whether we're filing 19 returns that are claiming deductions that if we end up getting forgiveness might cause a problem here. Short answer is I hope Congress fixes it. If they don't fix it, you're exactly right. It's an issue. It creates a potential timing issue. And I think we go back to the world where, if good costs are abundant, we can pick and choose the ones that we would most like to wrestle with. So if good costs are abundant, I might choose to add an extra week of July's payroll to rank and file employees instead of counting 2019's retirement contribution if it was paid during my covered period. So that's a way to avoid the issue that exists today for income tax filers that are still trying to wrap up 2019 taxes. For 2020, hopefully we get a fix this fall that Jeremy and I are both pretty certain that, as far as you can tell what Congress was thinking in any bill, that what they had in mind was these costs would still be deductible. But we'll see if they can get that done. If they don't, you're exactly right. Creates an interrelationship between the two, and that's an open question whether they will provide a rule that lets us go ahead and deduct those costs and then account for it as additional income if that proves to be wrong, or exclude those costs and then catch up those deductions on a future return, or whether we'd have to mess with amended returns. There's timing issues galore there, and we'll wait a few months before we try to dig into that.
Yeah, completely agree. I think short answer is send letters, emails to your phone calls to your Congress people, your senator, your representative. Get this changed, please, so that we don't have to deal with that question, because it does add a lot of complexity. So next question. If you apply in 8 weeks and turn in the application by June 30th, can you take the loan liability off of your financial statements and count that forgiveness amount as an asset as of June 30th? I guess my only qualifier to this is the asset's already on the books. So you have the cash. You should have cash and a liability. So in my mind, the question is do you move it to the P&L? Does that at what point does that loan become income? Here's, I guess, if anyone from our audit team, familiar with the GAAP basis of requirements associated with when you recognize that income, especially in light of revenue recognition, I'd gladly take a Teams message now to confirm or correct what I'm about to say. My opinion is I know whenever you get the forgiveness, if you apply on June 30th, the safe bet is when you get the decision on forgiveness, I have absolutely no problem bringing it into income at that point. From a liability. Once you get the forgiveness, it's great. Maybe there's a situation where you do the application and based upon, I don't know at what point you can say, I have enough certainty that this is going to get approval both at the bank level and at the SBA level that I feel confident bringing that into income. There's probably an argument for it at the time of application, but I know the safest answer is wait until you get the determination of forgiveness. But for a lot of businesses, that gain may be, it may hit through the same fiscal year, in which case it's irrelevant. I just received exactly what I asked for, like a message from heaven. GAAP guidance for gain contingencies makes taking it into income at the end of June questionable. Okay, so I think that confirms sort of my wishy-washy answer in that you apply as of June 30th. GAAP guidance for gain contingencies says I probably not black and white, that it's questionable as to whether you can include it then. You're definitely okay, obviously, whenever you get the actual forgiveness, whenever you get the actual determination of forgiveness. Thank you, Troy, for that quick answer on that.
Yeah, I think that's right. Jeremy and I were on a call with some other CPA firms, and there was some concern about potentially having a GAAP footnote disclosure at a minimum, potentially considering it for a contingent liability, even beyond the period the SBA had approved it, based on a fear that review might be subject to audit and correction or adjustment later. I think from everyone that I talked to on our audit team, that view felt overly conservative. But one thing we haven't touched on during this call yet is that there is an expectation that audits will be conducted for our larger PPP loan recipients over $2 million. And so that's another reason why we think that if someone got a large PPP loan, if they can show all the good costs for payroll costs, and if they can show, that it presents better on audit. And I'm not advocating a footnote disclosure or saying there won't be one, but I think that, users of financial statements may want to know that there is a unfinished business with respect to the PPP loan, especially for those larger loans.
Next question. Do commissions count in the wage deduction? Base pay is the same, but commissions down because of lack of sales. Yeah, I think we might have hit on this in the last presentation. I don't think anything has changed. My opinion on this is that, one, there is no formal guidance associated with this, but I think the spirit of this is that if the base pay remains the same, you're okay. The reduction in commissions because of a lack of sales should not count against you for a wage reduction standpoint. Here's why we would take that position. They explicitly stated if you have an hourly employee and you're paying them the same hourly wage, but their overall compensation is reduced because their number of hours are reduced because of this, you do not get hit with a reduction for wage reduction. It's going to impact your FTE number. And so because of that, that's the only difference, I guess, between my example and the comparison I'm making. Maybe there's a distinction here. I'm not sure there is. But they're saying, look, you have a reduction in hours for that employee. It is going to reduce your FTEs. That does not also create an additional reduction associated with wages. So I think my hope is you could apply that same logic and say base pay is the same. The reduction in commissions is going to it's not going to reduce you. It's not going to be counted for the 25% reduction, but it is going to make forgiveness more difficult because if higher commissions were in the wage base in 19, your loan was based upon them, and you don't have those commissions to count as compensation as a good cost. You have fewer good costs, but I don't think you get hurt from a wage reduction haircut standpoint.
Yeah, so Jeremy, I think that I agree with everything you said about this being a gray question. And because of the way the EZ form's structured, the wage question becomes really critical because in order to drive your bus through the gigantic safe harbor exception, you need to be able to demonstrate or certify that there was no reduction on an employee by employee basis of more than 25% for those under $100,000 last year. And I do think that there was a concern that if they allowed volume of hours to enter into the compensation question for wage reduction, that there would be double counting, that you'd get dinged twice for the same thing, a reduction in FTEs. So I think you were right to point out that you could differentiate a reduction in commission that's tied to a reduction in economic activity, which is unfortunate, but doesn't produce the same sort of double counting against you that they were worried about for FTEs. Whether the FTE rule is as compelling as it once was, now that many businesses will just drive through the safe harbor, I think remains to be seen. So I flagged this as an open question. I'd probably, based on what we knew today, if we were applying for forgiveness, I'd want to run the math both ways for those people and see what the result would be. And I think if you stretch this example to the extreme of somebody who's 100% commission, you'd have a hard time. I think you'd have a hard time justifying it in that extreme case, which makes me feel a little bit leery of how it would apply in a less extreme case. But I do know we had a lot of clients that converted people who were on commission only to some sort of elevated base pay for this period to try to cure this problem or proactively address it to make sure that they're on a net basis, they weren't going down by more than 25%. So I think that's still the safe move as far as I'm concerned. And because your because your ability to ignore FTE math altogether hinges on being able to certify that there wasn't a wage reduction, I'm a little bit more cautious in that area, maybe. But I'd say right now it's a real gray area, and a lot of these applications and things are going to be filled out with imperfect information, trying to apply imperfect rules.
Yeah, I think that's well said. And so, Steve, thank you for the nice words. Although since Mark and I have now given kind of, conflicting guidance on that last gray question, maybe he would take back his "thanks so much for the clear information" comment. But next question: if you received a PPP loan, oh, and this is a good one. We are getting this quite a bit. If you receive a PPP loan and also accept an EIDL loan, and do you still qualify for forgiveness? Is forgiveness reduced by the amount of the EIDL loan? I think we need to make one distinction here. There is a difference between an EIDL loan and an EIDL advance. And I'm thinking what Cole is referring to is the EIDL advance. The loan in theory I think the loan in theory should have no impact on your PPP forgiveness, other than you cannot use you can't use your PPP loan and the EIDL loan proceeds for the same expenses. That's a big no-no. But I don't think it necessarily impacts the forgiveness other than that. If you have an EIDL advance and you receive the EIDL advance and you received the full maximum amount of your PPP loan, your PPP loan forgiveness will be reduced by the amount of the EIDL advance. I think the way they had conceptually intended this to work was you got the EIDL advance, you applied for a PPP, you got the maximum amount less the amount of the EIDL that you received in advance. Now, this got all wonky because the timing of these things, people ended up getting the PPP loan proceeds in advance of the EIDL advance, ironically enough. So you ended up getting both the advance and you ended up getting the PPP loan. So let's give an example on this. You received a $10,000 EIDL advance. That money hit your account. In addition, you received a $100,000 PPP loan. Don't try to figure out whether or not the math works on this. Let's just bear with me for a second. Let's assume we got a $100,000 PPP loan. We received $100,000 of proceeds. We spent them all on good cost. Our business ran right through that big safe harbor, so we didn't have to worry about any of it. We got a loan for $100,000. We had $100,000 of good cost. We also had a $10,000 EIDL advance. Our maximum forgiveness amount is going to be $90,000. The $100,000 PPP forgivable amount of the PPP loan less the amount of the EIDL advance. So you are effectively paying back that advance. I believe I stated that correctly.
Yep, I think you nailed that there. And that's one thing that we did omit from our slides for simplicity, yep. Because many of the businesses that we're advising didn't participate in both programs, but I do know that there's a handful out there that did. And for those who did participate in both programs, again, for different costs, the advance, which is a check that the SBA writes you while they're processing your economic injury disaster loan, that EIDL loan is, while that's pending, you get a check for $10,000, and they said, well, we don't want somebody getting both and double dipping there. All right. There's a question here about a seasonal work safe harbor. I think we've talked about that's really based on what your baseline period's going to be if you have to do the FTE math. We have a question here, Jeremy. Can you file the EZ form if you're an S Corp with enough payroll costs to cover 100% of the PPP loan amount during the 8-week period? And so I think refer back to getting the step 7 slides when we publish those. The path to the EZ form is specified. You're not going to meet the first requirement because you're not a self-employed individual, independent contractor, or sole proprietor. So in order to, we have to answer one more question before we can answer this, and that is, can you certify that no one that we have to count are under $100,000 employees from Q1 that suffered more than a 25% pay reduction relative to their Q1 base pay? And if you can answer that in the affirmative, then the next question is, did you reduce your FTEs, or can you drive through the gigantic safe harbor? And answer to that second question of yes to either of those prongs will get you into the EZ form.
Would you mind, tell you what, Mark, would you mind attacking the next question about seasonal? I'm looking for an answer for the next question related to the EZ form and fired for cause. I'm going to see if I can get into the IFR that's referenced here and see if I can find an answer to that.
All right. So Pamela's question is on whether construction might be considered a seasonal business and might be used to cherry pick our FTE baseline period. Again, we come back to, let's make sure the FTE math is relevant to us. If the FTE math is relevant and construction was designated an essential business, and so we would need to be able to point to some reduction in business activity because of a policy we set relying on state, local, or federal guidelines, suggestions, or requirements that emanate from CDC, OSHA, or HHS. So if we can't get ourselves into the gigantic safe harbor, then it's plausible that we are favored by cherry picking our measurement period under the seasonal. As we alluded to, I think earlier in the question and answer, the definition of seasonal is still an area that we are looking for some guidance on. I think in the absence of it, if you think of yourself as seasonal, then maybe that's enough to carve out the filing position to file on that basis and run the math on that basis. So I'm going to throw out a maybe answer there and leave it at that for now. But our hope is that we continue to get some guidance as people are actually going to need to be submitting these applications on that help with that determination of whether you're in or out of the seasonal calculation for FTEs. But again, for those still listening, we only care if we have to do the FTE math.
All right, I guess I'm up on this one. All right, so the question is, if I do not fit in the safe harbor exception and fired an employee for cause, which led to a decrease in FTEs, am I eligible for the EZ form? Now, this seemed like a fairly straightforward question, but I think I know why the question was asked. Because if you go to the EZ form instructions, you can, so either you're an independent contractor, you fall under the gigantic safe harbor exception, or borrower did not reduce the number of employees or average paid hours of employees between January 1st and the end of the covered period. And it says, ignore reductions that rose from an inability to rehire individuals who were employees on February 15th if the borrower was unable to hire similarly qualified employees for unfilled positions on or before December 31st, 2020. Also ignore reductions in an employee's hours that the borrower offered to restore. It's easy for me to say, sorry, that the employee refused. So the issue is they say, did you have no reduction in FTEs, or if you had a reduction in FTEs, was it related to people that you laid off and then tried to rehire and were unable to rehire? It doesn't say anything about the terminated for cause. It does, however, reference one of the interim final rules. And so, it's one of those situations where both of those exceptions are mentioned as situations where you do not have a reduction in FTEs within that IFR. Both the situation that is explicitly mentioned in the application, as well as the question that John asked. Well, the question in the IFR, the guidance that I'm looking at says, will a borrower's loan forgiveness amount be reduced if an employee is fired for cause? I'm paraphrasing, but that's one of the situations. No, when an employee for the borrower is fired for cause, voluntarily resigns, or voluntarily requests a reduced schedule during the covered period, the borrower may count such employee at the same full-time equivalency level as before the FTE reduction event when calculating whether or not you have a penalty. So, we're splitting hairs here. And those of you who know me know I have no hairs to split. So I would say, yes, I think you can use the easy application on that. It doesn't explicitly mention that exception, but given that that's an exception that would allow you to get your FTE level as if it hadn't been reduced, I think you're okay with it. So I don't know, I might have overly complicated a very easy answer and an easy question, but I think the concern relates to the fact that that specific exception is not identified on the application.
And I think that's right, Jeremy. And for people who have easy access or ways to extract payroll data, if it makes you nervous, or if you've already been tracking some of these calculations from our May 27th webinar, it may make sense to figure out what your risk is. And if by marking the EZ form, we are getting a result substantially the same as what we would have gotten under the long form, or we've estimated it to be substantially the same, then your risk if the government later determines you didn't use the right form and did so in bad faith or something like that is not very big. Now I understand that's inviting you to do math that we're trying to avoid, which may not be welcome advice. But I think that kind of goes to some of these things are gray, and the great simplicity that we've gotten from Flexibility Act and some of the follow-up guidance creates new questions. And when we're thinking about whether those questions matter or don't matter, I think that it's helpful to at least have a hunch what the result might be if the answer is yes or if the answer is no to any of those individual decision points. Because it may be that what we're doing is we're taking advantage of a paperwork simplification, but it doesn't really change the answer of the dollars at issue. And if that's the case, then I think we can work through that separately. Of do we want to go ahead and do the easy form, or do we want to go ahead and show our full work and show how we'd get back to about the same spot anyway, especially if we're getting access to the safe harbor or to the ability to cure in step 4 that we covered. Jeremy, you want to tackle the next one on the gigantic safe harbor? We're trying to drive through it. How do we prove that we can?
Yeah, and so I think this is going to be one of those situations where there is no one specific piece of information. If you are a non-essential business and you are subject to whether it's Boone County, Cole County, or whatever county you may be in, if you were subject to a stay-at-home order, I think I would keep a copy of that in a file. I would keep a copy of the narrative of how you operated your business and how you adjusted your policies for that. So if there were company-wide communications that everybody is working from home, or we are shutting our doors, we are only allowing, individuals to work within these hours, whatever that is. I think I would create a narrative and an internal file that documents that. If you have, detail showing the reduction, I think this is a later question. If you can show that gross receipts were down, or a number of clients that you saw, or customers that you saw, or patients you helped were limited because you had to limit the number of, workers or physicians or whatever it is that you do, or you had to limit the number of people coming into your store to abide by these social distancing guidelines that were set by the county. Keep the county, recommendations. If you can show a reduction in foot traffic and customers within your store during this related to it, which I don't think would be that difficult, I think that would that would be what you needed. If you're a restaurant, you're going to be able to say, look, we only open, instead of having 10 tables open, we had we could only use 5 tables. And so we saw, we had X number of dollars less in proceeds. We saw, fewer diners, whatever it is. I think just create that narrative, but start with your policies, start with, the guidance you receive from either, whether it's directly from CDC or any of those business or any of those organizations, or whether it was from the county. Start with those, start with your internal policies, and then start layering onto that items that showed that you had a reduction in activity. And it doesn't necessarily have to be financial reduction. I mean, I think that probably follows, but, we saw fewer clients, for example, we saw fewer customers. We had fewer tables open. I mean, I think those two things probably work hand in hand, but one or the other should work. Both would be best.
All right, Jeremy, 9 questions to go. We got it under 10. All right. We have a business that's an essential business. They had an increase in FTEs because they are essential and they had more activity going on. They need more than 8 weeks to get enough good costs, but expect that they'll get there before the full 24. And they want to know whether they can get access to the EZ form. And again, they don't fit within requirement number 1 for the EZ form, or option number 1, because they have employees. And so the threshold to get to use the EZ form is, can they certify that they did not reduce the annual salary or hourly wage of any employee by more than 25% during the period compared to Q1. And when they say employees, they mean only the special class of employees that we discussed earlier. So that's the threshold for you to get access. And you would need to be able to either, in addition, certify that you had no reduction in employees, and subject to all the caveats that Jeremy just ran through on the fired for cause question, or fit within our gigantic safe harbor.
Next question is kind of relates to what I just talked about. For the safe harbor, what is the reduction in business needed? Let's assume we had a 25% reduction in revenue. Is that enough? There is no bright line test associated with that. I think if you are subject to the requirements, in other words, we had to reduce hours, or we had to shut down. 25% reduction seems perfectly acceptable to me. I think an answer probably less than 25% is perfectly acceptable. They don't specify, they just say you experienced a reduction compared to the levels pre-COVID, and it's related to your following guidance from one of these organizations, either directly from those organizations or indirectly via state and local governments, for example. So 25% seems like that should do the trick, and I'm not sure it even requires a reduction that's that high. Okay. Next question. Owner-employee is defined as a shareholder owning more than 20% of stock, period, correct? They don't really, I don't believe, and I'm going to kind of lean on Mark for this too a little bit, I'm not sure they define owner-employee. They at the beginning, they talked about self-employed individuals, those that filed on a Schedule C, Schedule F, partners, general partners in a partnership. I would probably conservatively treat anyone that has any stock ownership whatsoever as an owner-employee, because I don't believe they are referencing like the more than 2% rule, for example, because maybe there's a situation if you had someone that had a less than 2% ownership interest, but again, you'd be looking at attribution rules as well associated with that. Maybe they don't fall under the definition, but I don't see anything that ties the owner-employee definition to their use of, greater than 2% shareholders, for example, for other pieces of the tax code. So I think I would conservatively treat that as any owner-employee, period, and subject them to those limitations related to owner compensation, related to health insurance on their behalf, and what have you. Now the health insurance, again, if that owner employee is going to have their health insurance premiums added to their W-2, then it falls within that $100,000 limit that we talked about at the very beginning of this presentation. But again, I wouldn't lose sight of the forest here, in that depending on the nature of the business, if you have enough non-owner employee wages, then I think that's the situation that Mark talked about at the very beginning. You know, you've got the good cost that are black and white, and that may be the most desirable good cost from a simplicity PR standpoint. Those would be your regular employee wages. And then you've got your owner employee comp. I think you count your owner employee comp subject to the limitations. But again, some businesses may have an incentive to say, if I can get the good cost bucket filled without using any of those owner employee wages and benefits, that simplifies the whole thing. And I think there may be some benefit to doing that.
Yeah, Jeremy, I think the 20% that's being referred to there is drawing from there was a question on the application that looked at whether you were more than 20% owner for purposes of attribution and related party rules under the SBA. Okay. Guidelines. I think that may be what that's hearkening back to. I agree with the conservative approach is to treat anybody with actual stock ownership. An even more conservative approach would be to treat close family members of those people. And if good costs are abundant, that seems to be the wise thing to do. If good costs are scarce, then you let down the lower the walls there a little bit, and might let some of those costs that are less crystal clear come over into the computation. But I think you hit that nail on its head. Our next couple are on restaurants. So restaurants, I think that you and I would agree, Jeremy, that we could go out with a blanket statement that restaurants are significantly impacted by COVID-related reductions, social distancing guidelines. And it's hard for me to imagine a restaurant that does not meet the safe harbor, even if some aspects of their business have increased in revenue. So if you had a restaurant with a very small dining room, for example, and you say, we're going to close the dining room, but we are up on takeout sales by more than our dining room sales. I think there's the statute uses the word reduction in business activity. And I think you have a nail to hang your hat on there, that by closing your dining room, you have a reduction in business activity. And the reason I say that is the example that SBA gave us. They gave us a business that had online and local sales. Now, they didn't tell us what the relationship between those two was, but they did say that the closure of the store locally was enough to get you there. We didn't need to analyze whether there was an overall reduction in capacity, operations, or revenue.
Yeah, I would agree with that. They took the fact that they were silent on it seems to us to say that it's irrelevant to the discussion. And so even this, I think the second restaurant question here, I think is the most interesting one, in that it's, catering loss of about 80% of catering revenue. And I hate to say interesting from a fact pattern. Obviously, this is a horrible fact pattern, so don't misunderstand me with that. But interesting from a, how do you analyze it standpoint. So you lost the catering revenue due to a mandate of gatherings. I think the argument there in that situation is, and what differentiates it from client driven, is that even if someone had come to you and said, we want you to cater this event and we're going to have 500 people there, my guess is your internal policy would have been to not accept that based upon the guidance issued by CDC. I have a hard time thinking that most restaurant situations won't fall within that gigantic safe harbor. I agree with you on that, Mark.
So Jeremy, if your policy was that you weren't going to help people break the law by catering large events, then by having the policy to follow the law, maybe that gives you enough to say you're within the safe harbor.
Maybe. And that's why I said, that's why I think that's a more interesting one. I think that kind of moves more towards the who is actually causing the reduction. So I think there is a little bit of, it's not as clean as some of the other situations, but I think in most instances, there'll be something, as you say, that you can hang your hat on related to a reduction that's driven by COVID.
All right, we're down to our last four, 3 anonymous and 1 from inside our walls. So first one is on the easy form. Wanted to talk about the exception number 2, which I think means someone who says we didn't cut anybody's wages by more than 25% of the people that we need to consider. And we did not reduce the number of employees during the period between January 1, 2020 and the end of the covered period. There is some wonkiness and imprecision that runs through all of the guidance that SBA and Treasury have rushed out to us to try to get some answers to this ever-changing landscape. I personally have chosen to view that requirement as being congruent with a requirement that we did not actually reduce our FTEs when we do the FTE math. From a policy perspective, that seems to be what makes the most sense to me. They're saying use the EZ form. If you've looked at the numbers and there's not an FTE reduction or a wage reduction, that would water it down, that requires you to show your work, to show us how you came up with the numbers of your watered down good costs that you are doing from step 6. So that's the way I'm reading it, but there is imprecision in the words that are on the application. And the SBA and the banks are the sheriff. We will follow their rules. So I would feel comfortable with taking the position that requirement number 2, that path number 2 to the EZ form was met, if I felt confident that our FTE reductions were excused or cured. But I wouldn't file early if I was relying on the curing. I wouldn't file before week 24. And I'm not that troubled, I think, to the point Jeremy made earlier, by reductions in FTEs for cause and voluntary departures and the like. I feel like we can add those people back. That's what they're inviting us to do here. If we would add them back in the long form, then just tell us you've kept it the same. You don't have a reduction to calculate, and we'll take your word for it. But keep the records that support it in your file. Anything that you would add there, Jeremy?
No, I think that's exactly right. It's at a high level. Did you have no actual did you not reduce wages? Did you have no actual FTE reduction? And or would any FTE reduction that was mitigated by the phantom employees, basically they are not going, you can use this if you had a reduction in FTEs in what I would say real life, but for purposes of the calculation don't count because they were for cause, or you tried to rehire them. So I think that's really is what they're getting at with that. I think you said it well.
All right, next question is, and I'm struggling to get my mind around it. Maybe it's because we've been talking for an hour and a half or 2.5 hours.
You want me to take it?
Whatever it is. Yeah, so the question is 2.5/12 of 2019 SE income for partners that we now get. And then it says, can a potentially extra $5,000 be used on good costs in an application that's made after week 10? Okay, yeah. So the question is, we would need to get to week. Doesn't week 10 get us to 2.5 months, or darn close to it?
That's what I'm trying to do the math on. So the answer to the question is you prorate it, but by 10 weeks you might be at the 2.5. So.
Okay. So the question is, if someone's applying, if someone has a self-employed person on their application, the easiest thing to do is to wait till week 10 to apply. if you're antsy, so if you get to week like 10 and a half, then you've reached 2.5 twelfths. And or you can apply based on 850 seconds, but we don't want to do that. And so the question is, can we apply using a 24 week, but we're applying early in week 9, 10, or 10 and a half? Do we have to prorate? And I think the answer is yes, you'd have to prorate. Just wait till week 10 and a half or 11 or whatever the math works out to be.
I think it's week 11. So the specific answer, you're exactly right, Mark. The answer to the question is you don't get up, you can't take advantage of the 20,833 in say week 9. And so in your example, let's say it's 100,000 of income, 10 weeks divided by 52, you're at 19,231. That's your forgiveness. So yes, wait until week 11. And then apply for forgiveness in week 11, and that is the equivalent of your 2.5. I think that should get you to the 20,833.
Yeah, the math here gets fun when we're dealing with weeks, and we get 4.5 weeks to a month.
Yeah, that gets you to 21,000. Sorry, the 10. That's a 10 key. You hear how cliche am I? You can hear that in the background. So, but yes, so no. The answer is you don't quite get there after 10 weeks. Another question on the 3508EZ. So the example that they're giving is that the PPP loan was 100,000 and you had $100,000 of payroll in the 8-week period. Line 7 has you take 60%. You take 100. So in that example, loan amount is 100,000. All right. Good cost. And since we're using the EZ form, there are no haircuts. So let me grab my copy of the application. So line 5 is your total good cost. In this example, you have 100,000 of total good cost. No haircuts because you're using the EZ form. You can only use the EZ form if you have no haircuts. Line 6 is your PPP loan amount. That is also 100,000. So 100,000 in line 5, 100,000 in line 6. You take payroll costs that are being forgiven, and you divide it by 0.6, which is going to give you something greater than 100,000. So 100,000 divided by 0.6 just says that the maximum forgiveness you can get under the 60% rule is 166,000. In other words, all that's saying is you could have 66,000 of other good cost, non-payroll good cost, and you're okay. So you've got 100,000 of loan, 100,000 of good cost, and that line 7, the payroll cost divided by 60% is 166,667. You take the lesser of all of those amounts, and the full amount of $100,000 is forgiven. So a lot of math to get to the answer that yes, the full 100,000 should be forgiven. Agreed.
And I might just add, Jeremy, that's my scrubbed application right there. I'm not counting rent. I'm not counting utilities. Yep. I'm not counting mortgage interest. I'm saying all I want the government to see is that I got $100,000 and I gave it to my people as payroll. And in my hypothetical news interview, that's what I can say.
Yep. All right. Last question.
I think it's a maybe.
What's that?
I think the answer is maybe.
I think so.
To end on a maybe.
All right. So yeah, is it correct? That's always how we answer these. Anyway, is it correct that I can obtain full forgiveness if my PPP loan is 400,000? Okay. Wages during the 24-week period will be 700,000, but my FTE count will drop slightly. So say 46 FTE down to 38. So if we take 38 divided by 46, it's 82.6%, and multiply that by 700,000. You get 578,000 of adjusted good cost. Yes, you would get full forgiveness. Again, I think those situations always interest me because it doesn't seem like the true math is you shouldn't be able to get there. But again, in that situation where it was a relatively low reduction in FTEs, the 24-week period, again, based upon those specific examples, you crunch the numbers and it seems like you should be able to get full forgiveness associated with that.
Yeah, this is the question that I fumbled earlier, and you were alluded to the weird math in it is how someone is getting a $400,000 loan which is covering 2.5 months of wages.
Yeah,
and whether it makes sense that in 5.5 months they're spending almost twice as much with a reduction in FTEs. It's plausible. I assume these are real numbers. They're pretty, or close to real numbers, as they're pretty specific. So I think the numbers can work out to where this is a fact pattern that presents itself. And like Jeremy, it feels like it's not what Congress wanted to do, but really the gigantic safe harbor doesn't really reflect the spirit of what Congress wanted to do. The gigantic safe harbor says you were ordered to shut down, you're absolved from FTE math. The original act said you have to shut down. That's why we're giving you the money. Spend it on your people. So, there's been a shift in policy reflected in this. And so I'm not troubled by the fact that we get some unexpected or overly favorable results from it. But again, perhaps we can, so this person's still alive, and I think we got a clarification. So the construction company with reduced activity can still qualify for full forgiveness, and the answer to that is yes, because they give us 24 months to spend the money, and the part that I led us partially down the wrong path earlier, and Jeremy got to straighten out, is that the potential haircuts for wages and FTEs are all applying within the context of our 24 weeks good costs. And so when we water those things down, because we're counting for so many more weeks than the initial program was based, we can overcome that reduction with just pure magnitude of good costs.
Yeah. And to your point, I mean, again, I think the reason you have a hesitation is because the policy standpoint on this was at the very beginning was pay your people. It doesn't matter what they're doing or what they're not doing, pay your people. And suddenly as this, which again, for good reason has been extended, I'm not making absolutely no value judgments associated with this. This is a good result. As this, from a forgiveness standpoint, is we add the flexibility to it, you can still get full forgiveness. There are situations where you're going to get full forgiveness or close to full forgiveness, even in situations that may not be entirely consistent with what the original policy goals were of the program. As I think what happens, you're going to get these situations where, your FTE count is down a little bit, but as you clearly said and rightly said, based on the magnitude of cost we can include, you've been able to pick up enough business activity and keep enough people employed that you can still get full forgiveness, even without full FTE, the same FTE count you had before.
Whoa, that's a wrap on our questions. The point, there's an op-ed out there, I think it published in Forbes, that said basically, government, please just forgive the dang things. You've bent over backwards to make sure that everyone gets full forgiveness. And hopefully most of the people on this call do. And as we've illustrated after 2 hours and 40 minutes of talking, there's still a lot of nuance and complication to figure it out. So I am certainly a fan of the view of just forgive the dang things. Yeah. We've bent the rules so much to try to achieve that result that we're really not bending them that much more. I'm sure that viewpoint is dead on arrival in Congress, so have no illusions about someone actually doing something with it. But yeah, the unfortunate truth is we still have to wrestle with uncertain answers, difficult questions, imprecise language to get back to a result that most of the people who are still on this call and the 150 or so who started with us and have gone off to do other things with their day, that those folks are likely going to get substantially all of their PPP loan forgiven one way or another. Jeremy, thank you so much for walking us through this. And any other comments before we close it out?
No, I just want to say thank you again to everybody who's stuck with us through these. Again, the good news is they continue to kind of increase the flexibility on this. We're getting to the result where, you know, there are a lot of details, but we're getting to a point where we can say, do those details even matter, or can I get to the desired result and not have to do some of that, you know, nasty calculations on the back end? Is exactly what you said. We're getting to the point where more people can say, hey, here's our specific situation. You know, maybe we had some reduction in FTEs, but now we don't necessarily have to stress about how we calculate them. So again, you know, as we always appreciate your guys' attendance on these. You know, hopefully this doesn't become stale, like I said, in the next 6 hours. But as we continue to get guidance, obviously we'll continue to communicate to you in all manner of communications, both in person, via the alerts that we're doing, as well as these webinars. So again, thanks everyone for their patience, and thanks for the great questions. Mark, thank you for helping us through that.
All right, I'm sure we'll be talking to everyone soon. Thank you.